Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for January 20th of 2025. So we'll start off this week with a few charts from Visual Capitalist, something that I take a look at just about every week. This is their 2025 kind of outlook, if you will, and it's really kind of a consolidation of a lot of the different forecasts that are out there. And some I would say that I agree very much with. Others I would say that I agree perhaps less so. This is really more of a kind of a factual chart, and it shows you the net percentage of fund managers that are overweight U.S. equities. And you can see that this has changed over time. You can see on the far right here, we're really at record levels, eclipsing the prior peak in November of 2008. You can see the troughs there in 2005, 2017, and then March of 2023, which is obviously coming off that really bad year in the market for risk assets in 2022. But just coming into the year, we have a favorable backdrop for the economic data, but there are plenty of risks on the headlines. And a market doesn't like uncertainty. And as we look at concentrations, we're going to look at international stocks. We're going to maybe take a peek at valuations. And the setup here is that there's room for stocks to grow. There is an economic backdrop, which I said is favorable, but it's going to be perhaps a little bit more bumpy than we've seen in recent years. And so when you look at concentrations like this that are at record levels, there really is a kind of a buy-in to what's cited here in this quote from Commercial Bank of Dubai, is that there is a TINA trade. The U.S., there is no alternative really to the U.S. At this point. And I think you're going to see with the improving landscape in the international economic scene that that there's hope that diversification play in international begins to really start to pay off. Talking about global equities, we want to first look at earnings. Earnings then lead to valuation multiples, which help to dictate the pace and the future trajectory for equities. And so here we have on the far left, we've got the U.S., which by all accounts, this is still a forecast because we haven't received the full fourth quarter numbers yet, which we will here over the next several weeks, but estimated to be about 9% for 2024. 2025 earnings estimates looking more like 15% right now. I might suggest that perhaps is a tad optimistic, but if you look at the landscape, you got Japan, which is expected to show a little bit of deceleration, but still positive growth, and then Eurozone, which has really been kind of call it a weak sister of sorts, and they have the landscape for Europe looks a lot better this year than it did last year. And you can see Asia too, again, a favorable backdrop. So if you've got the international markets that are looking anywhere between, call it 8 and 13%, that's really not that bad. Earnings on an annualized basis, at least for U.S. stocks, you'd expect those in somewhere around a 6 to 7% range, and then add on a dividend yield, and average stock returns are kind of like +9, almost 10% perhaps. So, this is not out of line from what we'd expect over a longer term horizon. We look out into 2025, we've got potential positive and negative catalysts. And so this is a summarization of at least those from Visual Capitalists that they've taken from Bank of America. So on the left-hand side, you see some of the bullish catalysts. China, which has been a little bit weak, and the potential for Chinese growth, which certainly would help from an import and export standpoint. Chinese consumption moving higher. If you see Chinese growth accelerate, that's going to certainly help emerging markets in general. And then AI productivity gains. We've talked about this. I do think that AI is something that really plays out over a multi-year basis. But if you begin to start to see traction that AI is moving from kind of the buzzword phase to more of the implementation in core processes stage, then that could certainly help to drive productivity, could drive earnings, so on and so forth. And then obviously the overhang in the Russia-Ukraine war, if there is some kind of resolution there, that could certainly be beneficial. Now on the other side, we have some very discernible risks that could provide negative catalysts. You've got the global trade war with a tariff regime which is yet to be defined, that could drive expectations of higher interim inflation, which would in turn probably generate this disorderly rise in bond yields, which would be another negative catalyst. And if you do have that inflation, then the Fed might be motivated to raise rates, not lower them, as is the expectation now. So, but I tend to see, tariffs being perhaps inflationary in the short run, but to the extent that they are sustained, that they would really, in an age of declining money supply growth, that would be more of a hit to growth than it would be really a hit to long-term inflation. Biggest risks, this is kind of continuing on that theme from Visual Capitalist. You can see number one would be tariffs. And I like this word shock, because I think that is the kind of the operative risk there when it comes to tariffs. It's not the fact that, not just, the tariffs do have an economic impact, but I think the shock of them is a potential risk in and of itself, can influence money flows, can influence risk stance by both individual and institutional investors. So number two is inflation picks back up, and we do know that inflation's been a little sticky and in certain areas, but I think the trajectory is still down. But if that for some reason reverses itself, then not only would you take those rate decreases off the table, but you might even begin to expect a rate increase. Again, I think that's not necessarily the base case, but it's certainly a risk if you're trying to define those. And then geopolitical, conflicts. There are several of those that are listed here, whether it be China, Taiwan, Russia, Ukraine, Middle East, and I think geopolitical conflicts always are in the calculus for risks there. And then China, we've talked about the China expectations moving forward into 2025. On the last slide, that was a potential positive catalyst if China resumed growth here. But at the same time, they have their own risk factors, and deflation is a problem. Real estate markets have been in a downward spiral because they've had, ironically, they've had overbuilding in areas that have had no demand, and these buildings are now crumbling under their own weight. So that is a risk. And then a fiscal crisis, need I say more? I think the contention in Washington will be fairly well defined as we head into the spring. There is a debt ceiling that will need to be negotiated, as well as continuing resolutions. And I think all the horse trading that comes with it. A fiscal crisis is a pretty strong word, and I'm not sure that I would be that strong, but I think the fiscal disagreements amongst the major parties could be a risk as we head into the middle months of the year. So here we have tariff scenarios and kind of the potential impact on growth. This is from UBS as reported by Visual Capitalist in their annual forecast. You can see under selective tariffs, I mean, almost universally there's going to be a growth impact, which is what I've been talking about for a long time. Again, I do think that tariffs are more negatively impactful to growth than they are to long-term inflation. And then under universal tariffs, you can see the biggest hit would be to China overall. You see domestically, our economy, under selective could be, negative 0.3 to 0.5%. So, that is, maybe a 10% reduction in overall baseline GDP. And then, if you get into a universal tariff scenario, it's a lot more pronounced, maybe up to about half of the normalized GDP growth potential would be impacted there. And I would say that that right-hand side, the universal tariffs, at this point are fairly draconian. I don't think you do those in a vacuum without sabotaging other things. And I think that that these have been used as kind of a negotiating ploy. And I'd still suggest that even though there seems to have been a lot of rhetoric out there with Canada, Mexico, other trading partners, that we're still in the first innings of all of these kinds of negotiations. We have a gold price. We ended the year with a fairly good gold market. You can see here that we're looking at something that's on the low end, perhaps a slight uptick, 2750, and then you've got other forecasters out there that are looking for something closer to 3100, perhaps, and the estimate for the end of the year is about 2900. You can see continued growth coming off of really a fantastic year for gold. I kind of shift and look at quarterly earnings, and so you can see here now that we're kind of in the true chart mode. You can see the trajectory here on earnings. Fourth quarter, which I said we're basically on the eve of getting all of those fourth quarter reports now, looking at about 11.7% year over year. You can see that the trend line has been positive, if not perhaps growing a little bit, if you look at maybe a 6-quarter average. And so, again, expectations are for 15% year-over-year growth in 2025. And if we get that, I certainly feel like stocks have room to run. But I think there is a risk that maybe that gets ratcheted down perhaps a little bit, maybe around 10%, 12%. It's already, some of those estimates have already come down from like 18, 19% to 15%. So we'll just have to see, but earnings have been good. And I think, again, to the extent that we're able to generate incremental productivity from AI and from other things, we've had good productivity trends that will help to keep a lid on inflation. And if we see some mitigation in rents and maybe, slower growth of wages at a higher overall wage level, that could certainly be beneficial to earnings here for companies. So we have some S&P 500 forecasts based on those earnings that we've just talked about. So, here we have seen fairly strong growth in the S&P 500, and even with multiples that remain high, you see this range anywhere between like 6,300 and 7,100 on the S&P 500, which sits just a little bit below 6,000. The average here you see is about 6,700, and that is obviously where the preponderance of your observations are for those estimates. And so, again, if you get 1,000. If you get 1,000 on 6,000, that's about 16, 17, 18% growth from here. That would be fantastic. I think the consensus, or excuse me, not the consensus, but I think the conventional wisdom and where I'm at is something that probably provides a little bit more like, mid to maybe high single digits this year. Here we have earnings per share growth year over year, and what's important in this chart is the derivation of those earnings. So we've been talking a lot for better part of a couple of years about the Magnificent Seven, and the earnings for the Mag 7 are depicted in the pink here. But what I think is, and we've talked about this before, that as we get into 2025, you're going to see a higher concentration or distribution of earnings to the other 493 stocks. And so you're going to get more breadth in the market, you're going to get better participation, and I think that's extremely healthy. That's one thing that I have really worried about to some extent is the concentration within the markets, and now basically the top 10 stocks representing a third of the entire index. But The good news here is that there's a strong expectation of increased diversification of those earnings, which should lead to better overall breadth and performance for the rest of the S&P 500 next year. Here we have valuation, as I promised, talking about that. So again, normalized valuations. This is looking at S&P price to earnings ratio over the next 12 months. So it's looking ahead, not back. And so you can see here, just looking at 2020, you've got your line of best fit here, which is about more like 19. If you look over a longer period of time and look at trailing earnings, that average is actually closer to 16. So I don't think anybody's here to argue that maybe the valuations are stretched. And so when you get into an environment like this, again, looking at it, post-pandemic, and then we had 2022, and then we kind of enter the new year, things are a bit frothy. And what that does is it tends to put you on this kind of almost a perfection watch to some extent. So if there is a breakdown in earnings, then valuations are going to be impacted, and we're going to have more volatility in the market. Now, if the estimates are within striking distance, then maybe this can be justified. As I said, the increased breadth of expected earnings this year coming from the rest of the basically the non-MAGA stocks is good. And if those earnings are like 13%, then I think there is upside from upside in the broader overall market. But as you can see here, just to kind of highlight, that we're not at a point of extreme cheapness. Here we have some economic data. We've got retail sales. You can see here, this is food and services sales. You see that's positive. You got retail sales, ex autos and gas, again, positive, and maybe not perhaps, to the extent positive that we have seen recently, but retail sales, you really continue to look good. And so here we've got basically, through December, retail sales, you can see miscellaneous store retailers, sporting goods, electronics, furnitures, and then gas, which is interesting because we are probably going to see higher gasoline prices, based on what the tea leaves suggest and some of the correlations out there between crude and other economic indicators. And clothing was positive, and you can see here that basically you've got to get down to health and food services before you see something that's overtly negative, and then obviously building materials down here. This is a quick look at economic growth as it's defined by the blue chip consensus, a bunch of economic forecasters in this blue area. And then you have the Atlanta Fed. And if there's nothing you should take away from this other than this next comment, it's that the Atlanta Fed has done a really good job of forecasting economic growth. And you can see here that we have, it certainly has evolved over time. At one point, we were looking at well over 3%, and then we got some indicators that suggest it might be a little bit slower. You see the blue chip consensus is still like 2.3-ish, and the Atlanta Fed is now looking at more like 3% on the button, and that would be a positive surprise, positive development, because obviously that the range of estimates out there right now is not anywhere close to that. And so, that could have a positive impact, increase confidence on the part of risk-based investors, and probably have maybe some rotation back into risk assets if this does play out. And so, again, this is fourth quarter GDP or fourth quarter economic growth numbers, and we will get the first reading of that at the end of this month. Here we have some Philly Fed data, which looking at this data, it's just astounding in how strong it is. And as I've often cautioned all of you, don't get so wrapped up in the monthly data because it can be very noisy. But what's clear here on manufacturing, we've talked about fits and starts and the rolling manufacturing recession that we saw a couple of years ago, is That's all very valid, but manufacturing has been struggling to come back. Now, not all regional Fed surveys, this is just the Philly Fed, but not all regional Fed surveys are looking this optimistic, but this is one that catches the eye. Not only are you seeing that upward trajectory and improvement in overall manufacturing, at least in the Philly Fed zone, but you're also seeing this huge bump in the index. You're seeing a huge bump in new orders. And if you go and correlate that with the Philly Fed manufacturing index, which again, this is just a manifestation of this number over here, that when you overlay ISM, or the Institute for Supply Management Manufacturing PMI, which is Purchasing Managers Index, based at the end of the year, if you overlay those two, then you would expect, given this tight correlation over time, that you're going to have a bump in that ISM as well. And if you do, that is actually, from a psychological standpoint, going to be very important for the market. Here we have some unfilled orders, just more Philly Fed data. Again, the upward trajectory, and then this breakout here. You've got expected number of employees, so you've got positive expectations with regard to employment, which, if you're looking at it from a labor standpoint, this is also very, very good news. So on the heels of the Philly Fed, we're going to transition over to this chart, which is kind of reflective of, I think, where we're going to see the beige book go, and where we're going to see these regional Fed surveys, is if you do get that improvement in manufacturing, that you're going to have an upturn in overall, or maybe as this chart is kind of inferring, a reacceleration of the the ISM manufacturing and the service indices. And so this represents a blend. And we've been really treading water for a number of years, trying to find our footing, particularly on the manufacturing side, which has been extraordinarily weak. And you can see that there, is a large, going back to 1997, that there's a much greater incidence of ISM expansion, that we spent much more time in expansion than we have in contraction. And so we've been struggling to find our footing, but that data that I showed in the last chart, some of this other corroborating data, would suggest that those surveys are going to be moving higher in the months to come. So I mentioned the Fed's beige book before. The beige book really just represents a compilation of all the regional surveys, and kind of gives you a sense, in a very national sense in a national sense, a sense in a kind of a national scale, I should say, of where the overall economy is. And you can see not only are we in expansionary mode, but we are moving, we are trending higher in that data series. We have natural gas. This is NYMEX futures. We're clearly hitting the seasonal peak usage period for gas, particularly for heating purposes. And since we've got the return of La Nina and colder air over the U.S., that number has resumed its uptick. And this has been a pretty dramatic rise. Again, basically from the end of November, we've had this almost mercuric rise. And then the other thing that's really important here that I came across, this is out of like Bloomberg, but you've got LNG shortfalls. So you take this natural gas, and you liquefy it, and you put it on tankers and send it all over the world. And we do know that obviously the Ukrainian war has caused Europe to have to, rely a little bit more on U.S. for LNG exports. And, you can't build those terminals overnight, but you can see here that LNG shortfalls are forecast until 2027 here. And so, good news for U.S. energy companies, probably good news for overall prices that might remain a little bit sticky here, but just wanted to bring you up to speed on that. Okay, so we have a lot of stock information on this particular slide. Left-hand side, we've got advanced decline. It's a measure of strength in the overall economy. You can see the trend line from earlier last year was still relatively positive, and then that really did reverse itself at the end of November, which happened to coincide with the increase in volatility in the overall market. And you can see that that went down, well off its trend line. This is kind of an interim area of support for not only large caps, but also mid caps and small caps. And good news here is we've seen an uptick in the AD line, which is really symptomatic of maybe increased confidence. Again, we've had these little bumps before, so obviously want to make sure that these are stable, but you can see that that has carried forward in each of these markets, with the small cap AD line not quite like hitting its retracement level here from last October, but it is on a positive trend, and we do like to see that. Now, sliding over to the right here, we have the cyclically adjusted price to earnings ratios here in the dark line, and you could see here, and again, this is 10-year annualized forward returns, and so where we are now is about 38 times, which is, I mentioned before, that is obviously a high number. And you can see that this, going back to 1930, that that we have to go back to like basically the tech bubble here to find levels that are as high as they are now. And so, and then you overlay that, the S&P 500 10-year annualized forward return, and again, this is rolling 10-year numbers, and you can see that basically, valuations and actual returns tend to correlate very well. And so the idea is that if we're going to stay here at this valuation level, that eventually these forward returns catch up. And what's notable here is that this is an inverted axis. And so as this line moves higher, to maintain that correlation here, that the expected rates of return on the market go down. And in fact, the baseline here is about 3% if you look over the next handful of years, and that's pretty weak. But then you've got this high cyclically adjusted PE ratio here, but you've got basically a couple of standard deviations on either side of that line. Again, 13% expected here over a multi-year period on average, and then then you get expected 10-year returns that are in the single digits. And until valuation kind of rectifies itself to some degree, I think there is some validity to tempering your expectations on overall equity performance, even though this 3% might be low. So one of the things that gives me a lot of hope heading into the new year is the fact that companies are genuinely more profitable. And you can see that depicted here. These are operating margins. You can see how they have really moved higher here as of late, after hitting a bit of a trough here. But the expectation is that margins improve because of various things. You've got AI, you've got other productivity measures that help to rationalize cost, and so your operating margins are going up. That's a really good sign. If you look at the line of best fit across all this, then it probably looks like something like that. So we've kind of basically already punched through with some of these estimates on moving higher in terms of operating margins. And if you do that, then you're going to have, you're going to be able to maintain strong price to earnings multiples, which again might actually debunk that argument that you're going to have those ultra low returns that we saw in the last slide, that that you do have room for growth in equities and other risk assets based on that. And so the trend and the pace and how these expectations play out into reality is going to be I think somewhat important here, and we'll just have to monitor it. And then so we've talked about the contribution of the non-Mag 7. We see the earnings here for the Mag 7 very positive and really just driving the boat. And basically as recently as 2023, you had basically zero contribution from the rest of the S&P 500. But that has changed, and we saw that in a few slides ago, that you're seeing greater contribution and greater growth overall from these non-MAGA stocks, and that's a really good sign of breadth And if these are, truly, representative of operating earnings expansions that are driven by operating profits, then I think that the groundwork is definitely laid for continued stock growth, even if the multiples aren't going to change that much. One thing I've really paid attention to is the, not only the pace of company buybacks, but also the growth of dividends. In this chart, we're talking about buybacks. This is like company repurchases of its own stock in the market. You can see that we are well on pace to get to $1 trillion. And so, this is just another representation of the profitability of companies that are in lieu of paying dividends. They're just going to repurchase their own stock under the existing authorizations, and that's a really good thing for equities. Here we have insider transactions. This is we've seen a little bit of a bump here, and then we saw a little bit of bump there at the end of November. This is just insiders that are selling their own stock, and I think you've got a lot of company insiders that are just diversifying their holdings, and again, those over 20 to 1, and we're quite above that right now, are genuinely bearish. And so this is a bit of a contrarian indicator. If you see this thing perk up, then maybe on a near-term basis, you've got executives that are trading out of their own stock. Now, a lot of it has to do with tax planning. A lot of it has to do with diversification over time. So I'm not saying that that's the entire case here. I do think that the new administration and some of the uncertainty, even though CEOs and chief operating officers are, have by and large been more positive lately with regard to the economy, there's still policy uncertainties with regard to the White House that have probably prompted some of these executives to take some of their chips off the table. Here we have a survey from S&P 500 Global. What is your outlook for year-end 2025? And this is essentially a sentiment indicator. So these numbers are all really kind of relative, but you can see that that U.S. Even going from October in the light color to January here, this month, you can see a big breakout in the expectations for the U.S. Rest of Asia, perhaps a little bit more subdued, but still relatively positive. And then Japan is marked by a significant change here. And then you go down to some of these other areas. Europe is positive, but again, not blockbuster so. And then mainland China, which as recently as October, expected to grow a lot, and then now those have all been ratcheted back, as we've been talking about. So very interesting dynamics at work here. Here's a distribution of global GDP growth. This is kind of an amalgamation of a lot of different jurisdictions. You can see here that global growth picking up ever so slightly here, which could actually surprise on the north end. You've got a lot of expectations for roughly 3% growth this year, and I think that's relatively doable. So on this slide, we talk about the U.S. dollar just a little bit and some of the dollar sensitivity that is out there as we head into the new year here. On the left-hand side, we've got an overlay. In the red, we've got basically S&P 500 earnings per share, and you can see that has moved higher over time. And then we have overlaid in black is the spot U.S. dollar, and you can see that we've had some notable jumps when we've had kind of flat earnings growth, oddly enough. And so, we've seen a bit of a chop in the dollar lately at a time where we're seeing some notable earnings expansion. And so, one would think that this is going to continue to catch up with that, perhaps. And so, again, the dollar's been very strong, and not too long ago, a couple of years ago, we saw a peak in the dollar. But it's certainly maintained itself at a much higher level. And then over here we talk about sensitivity, and I think these are all things that we should be being mindful of here in 2025. Is the sensitivity of sales growth to changes in the dollar. And so when you have a strong dollar, then you think about some of these areas in the overall S&P 500 being adversely impacted. So you're going to need more domestic growth. You tend to have kind of a negative impact there, and with higher U.S. Dollar growth, and where you get the most adverse impact, you get materials, which is not too surprising because a lot of those commodities are priced in dollars, and then energy, which obviously crude is priced in dollars, that goes without saying, but also consumer staples, and to some lesser extent IT here. But these are all things that we want to track heading here into the middle of the first quarter of 2025. Now we'll kind of resume our conversation about earnings here. On this left-hand side, we got in black the normalized next 12 months earnings per share, the S&P 500 here. In the purple line, we've got the same data points for the Russell 2000. And you can see that, going back to 2015 and just really even before that, there's a reasonable correlation. And even when you get these magnitude gaps here that are odd, but this is the pandemic, and so this is a very disruptive period, that at least you had directionally the same direction on both earnings growth for essentially the S&P 500, which kind of accounts for about 80% of the overall market, the Russell 2000, which is really predominantly smaller caps. But we haven't seen this kind of gap, and a lot of it has to do with increased treasury yields. You can see that basically this is inverted on a right-hand scale. So, you look at the beginning of 2024, we were about 3.7-ish, or excuse me, September of 2024, we were at, 3.6, 3.7. And we've seen a very dramatic rise, and that has helped to exacerbate the gap that already existed here. We've often made lots of comments about the relative value disparity and how small caps are really undervalued, which is true, which is definitely true. And the fact that you've got S&P 500, which is dominated by technology stocks, you could argue that maybe they're overvalued a little bit, but basically when you have this kind of a level on the S&P 500, you would expect small caps to begin to participate. Once the dollar strengthening levels off, and then you just wind up with a strong dollar that's not necessarily moving as much, then I would tend to see these kind of narrow themselves out a little bit more, and small caps tend to perform a little bit better. Little bond market data here. On the left-hand side, we've got the 20-year Treasury bond ETF, the TLT, and just like we saw in that last chart, we've had a very pronounced move here, and this is representative of an dramatic increase in yields over a very short period of time, which has resulted in a price drop. So we know that higher yields translate into lower prices for the bond instruments and the exchange traded funds that kind of mimic them. And as a result of rising rates, you've seen this particular security go way down in value. And then consequently, you see the term premium. This is symptomatic of a yield curve which is now entirely positive once you get past out 2 years. And you see that term premium really rising quite a bit. So obviously something that we'll have to monitor, and very symptomatic of what I would say in many respects is like a normalizing market, because you're getting back to baseline long-term yields that are above short-term yields, and you're not dealing with this this inversion that we did for a very long time. I'm going to end on this slide, just a kind of a humorous and interesting one of note, because I think we've all paid attention, those of us who watch NFL football, for that matter, and even at the college level, these guys are making much longer kicks than they used to. And I always, thought to myself, is this real? Am I just imagining this? But it's actually in the data. So when you go through, 1999, 2003, kicks that are roughly 55 yards, there's a 1 in 4 chance that your kicker would make it. Now there's almost a 2/3 chance that they'll make it, and it's very interesting to see that these in these little epochs in time throughout the football that you see much greater accuracy on some of these kickers than you ever did before. Well, that's all I got this week. Hope you've enjoyed the chart pack, and take care, and we'll talk to you again soon. Bye.